Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to the latest episode of our podcast. This is Ajeya Shekar, Vice President with Provident Healthcare Partners. I'm joined by two colleagues of mine, Eric Major, who's a Vice President at Provident, and Stephen Grassa, who's an analyst with Provident. The topic of our podcast today is physician services consolidation and investment. Physician services is an area that here at Provident, we've done a lot of work in. Over the past 4 years, we've done about 45 transactions within physician services, really across a broad spectrum of specialties. And we wanted to take some time here today to talk through some of the basic questions that we get from physician groups across the country, irrespective of specialty, about why consolidation is happening at such a quick pace within their world, and also what some of the dynamics are relating to transacting with physician groups today. My colleagues here, Eric and Steve, have spent a lot of their time, respectively, within the physician services world across a number of subsectors. So we're excited to get their input on some of the most common questions that we get from physician groups across the country. As a starting point, Eric, maybe you can give us a little bit of insight on how we really saw the genesis of investment and consolidation activity within the physician services world.
Yeah, I think from a private equity perspective, it did start in the 90s, more on the outsourced hospital side. So, anesthesia being one of the, first specialties to start to see private equity investment, in the mid 90s. We also saw on the outpatient side in the 90s, there were some, publicly traded roll-ups that occurred in some specialties, such as in the pain sector, there was pain care. In the ophthalmology sector, there was PRG. There was Phicor, who was more of a kind of multi-specialty roll-up strategy. That in those publicly traded shell companies, most of them ended up going bankrupt or going private at some point. I think the mistakes they made were typically they were looking at either 100% buyouts of physicians where they don't have any incentives post-closing, or the groups that did get some stock within the publicly traded company, they saw the value of that stock plummet after earnings were missed, for example, which really goes back to why we don't see too many publicly traded healthcare companies, because you are judged on a quarterly basis by your earnings and hitting those earnings targets, which can be difficult with reimbursement swings and other productivity issues you might have with your physicians. Where we've seen the most success is with private equity in the physician services world. So, starting with anesthesia, we started to see these groups kind of expand into, other outsourced areas as well, such as radiology. On the outpatient side, in the late 90s to early 2000s, there was investment within the dental practice management sector. Many of the private equity firms that have since invested into physician services, started with investments in dental. Steve, you can kind of comment on maybe some of the more recent physician areas where we've started to see a lot more activity. And
some of the recent areas in which we've seen consolidation activity, think of interventional pain management 2008, dermatology 2011, ophthalmology in 2014. This recent wave of consolidation, we've seen a number of platform investments into the sector, and what we're seeing is it's some of the same players that, as Eric mentioned, that invested into the dental practice management sectors in the late 90s. And so these groups are parlaying their experiences and trying to replicate their successes in these sectors. For example, the Audax Group is a Boston-based private equity firm that had a successful investment and exit in the dermatology sector in 2011, and they've subsequently closed on platform investments in new and exciting sectors, gastroenterology, OBGYN, and the urology sector. And so what we're seeing now is with private equity firms entering the space and with platforms that are backed by private equity capital, trying to make acquisitions to earn a return for investors, it's causing a situation where there's competition for deals and a massive supply and demand imbalance in the industry. And so we're seeing valuations, correct me if I'm wrong, guys, that are very elevated from a historical standpoint.
Yeah, those are all very interesting points. And I think for a lot of the physician groups we speak with, for a very long time, the only M&A opportunities were with hospital systems or mergers with larger multi-specialty groups. So what we've seen develop over the last few years has been kind of a unique third party that is a single specialty that thinks very similarly to how they view the world. And certainly private equity has been a big proponent of some of this consolidation we've seen. Steve, from an investor perspective, what's really in it for them in terms of investing into physician services practices? Are there any trends that they see very attractive within this market dynamic, or what are kind of their goals and motivations having invested into these subsectors to date?
The thesis for physician services from a private equity perspective is very multi-layered. One, the healthcare services sector and physician services specifically are very non-cyclical in nature. So, less sensitivity to economic swings and shocks. And if we're to see a recessionary environment at some point in the future, these sorts of companies would be affected a lot less than some of the more traditional cyclical sectors. And then you have demographic macro level tailwinds such as this secular shift to outpatient settings and aging and expanding demographic and population, as well as expanded insurance coverage. You couple that with the fragmented nature of these markets. It's not like retail where there aren't any big behemoths or national consolidators. It's a very fragmented market, and which is very conducive to the private equity model, which is predicated on acquiring a platform investment and layering in add-on acquisitions from there.
Yeah, and I would even add that it's as simple as investors tend to follow each other as well. So, physician services wasn't on the radar of many investors, years ago, but once the first few groups started to make those investments, had success within the sector, you start to see other private equity firms, recognize that there's a lot of opportunity within, various subspecialties, and therefore they start to put together some research and, make their first investment within the sector.
Private equity is very well capitalized at this point. Fundraising levels have been wildly successful over recent years, and debt is very inexpensive at this point with the low interest rate environment we're seeing. And so, we're seeing groups deploy all this ample capital that they have into businesses that align with these theses that we're discussing.
Yeah, I think those are great points from our discussions with private equity firms. We're certainly seeing that follow the leader approach that Eric mentioned, but also private equity firms that have had previous experience investing into dental, start thinking about similar retail, multi-site driven physician businesses in urology and ophthalmology and GI as, relevant corollaries to that initial investment. And, I think it just speaks to the ongoing opportunity within physician services from an investor standpoint. But maybe, Eric, help our listeners understand the flip side of the equation from the perspective of physicians and operators within this sector. Why pursue a transaction today?
Yeah, I would say, one of the big factors for physician groups and why we're seeing so many look at these transactions is, historically, they never really had an opportunity to sell their equity within the business other than potentially selling it to other physicians. And the types of valuations and buyouts that they would get upon retirement, would be, relatively minimal compared to what you could get, on the open market. So part of this is that physician groups historically never had the opportunity to sell equity to an outside, third party. The presence of private equity has resulted in, the opportunity to monetize some equity within their business. And just from a wealth diversification perspective, if a shareholder has a meaningful ownership position in a physician practice, there's the opportunity to really take some chips off the table. These aren't 100% buyouts. This is typically a 60 to 70% of your shares would be sold within the business. And, that's a great opportunity for a physician at any age to really diversify their wealth and, make some investments in other assets and continue to be a meaningful owner within their businesses as well.
Yeah, that's very helpful, Eric. And, from our experience, there's been commonalities between both the strategic consolidators out there and the private equity firms in terms of how they structure the transactions. Steve, maybe you can provide our listeners with just a bit more background on how these two models differ and what options are out there from a transaction perspective to physician groups today.
Yeah, we're currently seeing two main cohorts of buyers that our clients are ultimately opting to align with. The first is a private equity investor who does not have an investment in a given specialty, and in that instance, you're serving as a platform investment for that private equity firm. The second is being either a regional hub or an add-on acquisition for an existing platform that already has private equity capital behind it. And so the difference is, in being a platform investment, the private equity firm is going to leverage your infrastructure and back office systems in place to try and scale the business from there. In that model, there's a little bit more autonomy than joining an existing platform where there's less flexibility and more rigid processes. And in that instance, you're the consolidator with potentially having board seats and having a louder voice in terms of high-level strategic decision-making.
The transactions we're seeing out there, not every group is going to be that platform or regional consolidator for an outside group. What are kind of the key characteristics of a physician services platform in the market today?
Typically, private equity firms entering a new specialty are going to look for, robust infrastructure in terms of back office systems and processes to be able to support future growth of the business. Clinical reputation is very important when identifying investment opportunities, as well as an attractive geography. The flip side of that, if you're an add-on acquisition or a regional hub or a regional beachhead for an existing platform, you're going to be able to leverage the platform's infrastructure that they already have in place, participate in the growth of that platform, mitigating risk from the other geographies.
I guess from the other side of the equation, for physician groups that are thinking about approaching private equity or a strategic partner, how would you recommend that they vet the right organization to partner with? Eric, have there been any kind of key points that you tell your clients to keep in mind as they think about this sort of thing?
Yeah, in terms of kind of vetting the right partner, I think if it's a strategic entity, certainly understanding who their leadership is, who you'll be interacting with on a daily basis, who their private equity partner is, and what their historical experiences have been within the physician services sector. If you're looking at direct partnership with a private equity firm, I think it's important to talk with references of maybe physicians that private equity firm has worked with in the past. We typically, have a bias in our processes towards private equity firms that have experience within physician services. Groups that are making their first investment into a physician practice, there's certainly a learning curve in terms of how to interact with physicians, how to execute on add-on acquisitions, and really scale these businesses. So PE firms that have done this in the past, typically, we would say that they're more likely to be successful in their next investment than someone who's doing this for the first time.
In echoing Eric's point, related experiences and successes for these private equity firms is very important. Healthcare is a very complex sector, and when you're dealing with provider-based businesses, it gets even more esoteric in nature. So an established track record of success in investing in physician service verticals is very important in choosing a partner. I'd also bring up the fact that a lot of the cohorts of buyers have varied management approaches, whether that's local governance post-transaction or autonomy post-transaction. And so, culture of the practice and vision for growth, having those match up and align with your potential partner is of the utmost importance, because we've seen personality fit and philosophical fit be a key determinant in success of a partnership.
I guess from a timing perspective, Steve, I think you brought up earlier that there's a big supply and demand imbalance, which is leading to valuations being fairly attractive today. But walk us through how to think about the right timing to approach a deal, especially, let's say, if a practice is growing, or even from a shareholder motivation standpoint. Sometimes we see large differences in where shareholders are from their own kind of personal career development. So you see sometimes very old shareholder groups where there's a number of people that are at retirement age, and in other cases you see younger shareholders that have just graduated from residency programs, medical school, and have a very long period of time ahead of them before they even need to start thinking about retirement. How do you start thinking about and broaching those topics with groups that may have different motivations based on timing and just their shareholder makeup?
Yeah, it's a tricky question, and it's not the same for every practice. Typically, practices that command the highest valuations and the highest multiples are those that are coming in from a position of growth. So groups that are growing at a strong clip over the last, call it 2, 3, 5 years, are going to command the highest valuations. From a shareholder perspective in ciphering between young shareholders and older shareholders is varying motivations for each group to pursue a transaction. If you're a younger shareholder, it's more of an equity play where you're retaining more equity and focusing on the subsequent second bite of the apple. You'll have the ability to retire any medical school debt from your cash proceeds at sale, and you'll alleviate the administrative burden that's inherent in running a practice. For some of the older physicians, you have the opportunity to retain less equity and take out more in the form of cash proceeds in a sale and use it as a transition plan to transition to retirement.
Yeah, and I think just from a macroeconomic perspective, the timing is affected by changes in the economy. Valuations certainly do ebb and flow with changes in interest rates, for example, because in these transactions, as we'll talk about on subsequent podcasts, private equity firms will use a combination of equity and debt in order to finance these deals and finance growth. If there are increases in interest rates, for example, we've benefited from many years of low interest rates. They're starting to increase a bit, but they're still low relative to historical norms. If interest rates do increase a meaningful amount, valuations will subsequently fall. So it is important for groups to kind of keep a pulse on what's going on with the economy and understanding that waiting and waiting for growth is always a good thing, but certainly there's no guarantee that valuations will be at the same level that they are today and have been the last couple of years.
I think those are both great points, and what we often run into, to Steve's point, was we see younger shareholders that are motivated to do a transaction. You see older shareholders motivated to do a transaction for obvious reasons as well. But it's really kind of those groups of shareholders in the middle that aren't quite at the beginning of their career nor at the end, but have a long path ahead of them from a practice perspective that are often the ones that require a lot of education and convincing out of a deal. Eric, I think your point about keeping a perspective on future market conditions and risks can certainly play into that. But I think it may be helpful as well for our listeners to understand a bit about how some of these physician practice transactions are structured, because I think that the way that you think about rolled equity and the multiples may have kind of a part to play in how some of these mid-career shareholders can think about a transaction. Eric, would you mind kind of walking us through what that typical transaction structure looks like for a physician practice?
Yeah, for shareholders in the middle of their careers, and certainly doesn't have to be exclusively for them, but what we see more often than not is the first transaction with a private equity firm, they might take 60-70% of their individual equity within the business and still maintain a meaningful equity position going forward. If you think about the private equity model and what they're trying to do, their hope is to grow the value of the practice over typically a 3 to 7 year period before pursuing a secondary transaction with either a private equity firm or a strategic buyer. For a physician at the middle of their careers, they could certainly take some chips off the table, and then upon that secondary transaction, have the opportunity to again sell a portion of their equity, but still maintain and roll over a meaningful ownership position going forward. So for a physician that maybe has 15, 20 years left in their career, this could be an opportunity to see multiple different liquidity events or multiple different transactions over the course of their careers, while continuing to take some chips off the table at each deal, but certainly not selling out to the point where it's a full liquidity event and there's still 15 years of being an employed physician left in their careers.
Yeah, and I think when you keep the private equity desired returns in context of 3 to 5 times invested capital, those can be very meaningful scores for individual shareholders at each liquidity event or bite of the apple, as Eric mentioned. And I think one of the most common concerns about physicians about these private equity transactions and just transactions in general are what life looks like post-deal, as well as the risks involved in going through this sort of model. Steve, maybe you can help us out and start kind of walking through some of the most common risks that we see through this model and how we've tried to mitigate them as part of our transactions as well.
You hear about private equity deals that are straddling companies with debt, coming in and cleaning house and reducing administrative staff, but what we're seeing in the deals that we're working on in the lower middle market of healthcare, that just simply isn't the case. So typically, the private equity firms use a lot less debt on those deals than the mega buyouts that you're reading about. And in terms of reducing administrative staff, private equity firms are here to augment the existing staff, management staff, existing processes, and systems in place to continue to grow and build upon that growth, not strip down the whole enterprise.
So I think two of the bigger risks that we see with physician deals, the first one is really partnering with the wrong group. That could be a private equity firm that doesn't have any experience in physician services, and therefore they're more of a capital partner, but not necessarily a sounding board in terms of making strategic decisions at the board level. Maybe a group that hasn't had experience doing add-on acquisitions, which are always going to be part of the growth strategy of a physician investment. I think the second risk that we see is not having alignment with the shareholders post-closing. So transactions where perhaps a private equity firm comes in and acquires 90% of a platform or 95% and leaves the shareholders with minimal equity going forward. There's certainly going to be reduced incentives if shareholders have a fairly minimal ownership stake in the business. We've seen more and more deals in the physician services world have at least 25% rollover equity position of the shareholders, up to more often than not somewhere in the 30 to 45% range. And I think that does provide a lot better alignment. With that alignment comes also a compensation package that is incentive-based, that doesn't have components or a significant amount of flat salary as part of it, because that does align, and make sure that the shareholders feel like it's similar to an eat what you kill model. Maybe there's some salary, some draw within that compensation package, but they have upside from their ability to produce more, or they benefit from increased rates that are generated by renegotiating contracts as they grow scale within their market.
We've obviously seen consolidation happen across a number of physician service verticals to date. In both of your opinions, where do we see the next kind of hot sector of physician services for investment in consolidation?
Yeah, I would say we're hearing a lot right now about the gastroenterology sector. So while not the newest sector, there's really only been one private equity deal to date. There are a number of transactions that are on the market. I expect that sector to see multiple platforms emerge in the next year to 18 months. Other areas, the urology sector, another area where there's really one investment so far, but there are multiple groups that are looking at potentially aligning with a capital partner. And additionally, I would say newer areas where we have yet to see investment, but recognize that there are a lot of dynamics that are attractive to private equity. Neurology comes to mind as a sector where there has yet to be significant consolidation. Certainly the ENT sector, where hospitals have historically been the consolidators. I think there's room for private equity to invest into some of the larger outpatient practices, and we're hearing about potentially some deals that are occurring on the market. Steve, any others that you would have in mind?
Yeah, I think any real specialty that hasn't experienced any real form of consolidation is ripe for the taking in terms of new investment in the space. Primary care side is another interesting vertical within the physician service realm, which has seen a lot of consolidation activity from payers. Optum, the physician services division of United Health, has been very aggressive and very active in that market in acquiring primary care practices and multi-specialty practices. And we can envision a situation where other payers get involved even more so as time goes on.
Great. Well, I think this was a very helpful overview from Eric and Steve on some of the most common questions we get from physician groups regarding M&A and private equity. I think in future podcasts, we certainly have the plan to delve into specific subsectors and subspecialties of physician services that have gone through various levels of consolidation. But we'd love to hear your thoughts and comments. So please feel free to leave us a review on iTunes or email us at podcast@providenthp.com with any ideas or thoughts or suggestions. We'd welcome them and look forward to sharing more on subsequent podcasts. Thank you.